fully that you're going to get 10 interest payments, and you're going to get 50 grand back. So you know exactly what your rate of return is going to be. As soon as you sell early, you're subject to the market and what's happening or what's expected to happen during that time period. And indeed, what actually happens when you want to sell it. So that's where the risk comes in this transaction. But going forward, all you can do is predict what it's going to be and then decide whether it's a good investment for you. Whether it is or not is a function of whether you predict it correctly or not. So that's it. Okay. So that's sort of typical of a financial analysis in terms of Chapter 3 material. Okay. I want to talk a little bit now about engineering projects. So finally, we've got all the basic tools to be able to analyze engineering projects. And so what I plan on doing is talk a little bit about the capital budgeting process, that sort of overall process within which, as engineers, we find ourselves in terms of coming up with the money and presenting our projects. And then I'd like to talk about engineering projects on a before-tax basis. We'll look at the techniques just in terms of before tax. Then let's talk a little bit about the Canadian Income Tax Act and how it affects engineering projects. And then come back to it and ask the question, well, what's left over after we pay our taxes? Because that's really the only value of interest to shareholders or the company. And that will take us probably next two or three weeks, I think. Okay. Then we'll start talking about the public sector and government projects. Let's talk about the capital budgeting process. Very, very important in the company because it really decides the direction that the company is going to go in. Definition of capital project or capital budgeting item is simply an expenditure where the benefits associated with that expenditure will extend beyond 1 year. So the obvious thing is, a project, a 5-year project that requires engineering equipment, well, that's a 5-year benefit, current expenditure. Plant, equipment, property, that sort of thing. What's not so obvious is perhaps expenditure in a marketing campaign. So we spend an awful lot of money now, and that marketing campaign, that effect on our brand, will occur over the next 2 or 3 years. The benefits associated with that, that's a capital project as well. Okay. And so what we're trying to do is to justify that current expenditure against the future revenue stream that we're going to get, the future profits. So that's what we're trying to do. It's a topic that really affects everything or everyone in the company, and it is significant in the sense that it's a marketing plan, it's a production plan, it's an engineering plan for that time period. Okay? And you're committed to doing it because of the nature of these investments. Think about if I spend a lot of money on a plant and equipment and I get it wrong. Well, we talked about sunk costs. Think about how much of that investment is recoupable. Well, if you got it wrong, you're not going to be able to sell it to a competitor, or you may not want to. And so you may be looking at 20 or 30 cents on the dollar in terms of return. Okay? If you did get it wrong, you need to sell it. So very, very important because of the irrevocable nature of these expenditures. Think about the commitment that the company makes. So if I have a 5-year project, in a sense I'm getting marketing involved because I've got a 5-year marketing plan. I mean, I wouldn't be spending this money if I didn't think the customers were there and the revenue was there. I've got the engineers involved because they're designing how we're going to do it for the next 5 years. I've got production and operations involved because they're going to be manning this stuff for the next 5 years. And of course, the money that I need, corporate finance is in there. So all of these players get together and come up with the plan for the next 5 years. Central to all of this is the board of directors, because this is where these very, very significant decisions get approved. And again, board of directors sort of in the middle between the management, so they're directing management, but they have a fiduciary or position of trust responsibility to the shareholders. In the end, they're making sure that management's doing the right thing for shareholders. Okay. And we'll talk about that in a second when we look at the actual cost schedule. Okay. So essentially, it's a long-term process involving all of the company, very, very significant in terms of the commitments that are being made and the nature, the magnitudes of the expenditure. Well, let's talk a little bit about that in terms of its significance. Well, long-term effects, I think I suggested to you, we're making a 5-year marketing plan, a 5-year commitment to a way of doing things, 5-year commitment of funds, because rate of return will mean that the money will come back to us over the 5 years or to shareholders. And as a result, we've lost flexibility. So we want to get it right. Okay? And when you think about, well, we want to get it right, well, what does that mean? Well, we want the right level of investment. What are the two possibilities of not getting it right? Too much and too little. What are the consequences of getting too much investment? So we're really ambitious, We've got all of this marketing that says we're going to have all of this revenue, and they're wrong. Marketing's wrong. So we've got all this capacity that's not doing it. Well, obviously, unnecessary extra costs, which we may not be able to sustain. How do you trim the cost? Well, you spent the money on the equipment, it's there. It's very hard to trim. I started my career out at IBM many years ago when they were a very, very strong monopoly, and I used to have to visit various plants down in the United States. And these were huge plants, and I always was amazed at how idle they were. It seemed like we had all this equipment, there was no one there, they weren't doing anything. This was the time when IBM was a very strong monopoly and could absorb all sorts of costs. And their commitment to their customers was, we can deliver. And think about the good thing about being overinvested. You've got all of this capacity that when there's a spurt in demand, you just rev up the capacity. You can produce whatever your customers need immediately. Right. And that was the IBM model. They had this capacity, and they could deliver. Whereas their competitors perhaps didn't have the equipment. It took them 6 months or a year to get around to it. Well, of course, all the equipment was delivered and paid for by the time the competitors managed to catch up. Downside, of course, well, when there was competition squeezing out the prices, there wasn't the margin to be able to support that overinvestment. So the downside to IBM really bought manufacturing capability because it's cost. Okay. I think, though, of the two sins of being overinvested or underinvested, the major sin is underinvestment for two reasons. One, if I don't have a right level of investment, maybe I've got an old plant and equipment. So if my competitors are up to date, I can't deliver in a cost-effective manner. And eventually, over time, profits are going to get squeezed, and I'm not going to compete. But I think the main problem is loss of market share, which was what IBM was trying to avoid. Think about the nature of these assets. Okay, so we were running at capacity all the time, and all of a sudden there's a spurt in demand. Well, what do? Increase capacity. Overnight? No. If it's a major thing, it's going to take us 6 months to raise the money, 6 months to get the capital equipment, 6 months to get us in. So 18 months from now, we can react. Well, if our competitors are smart and already have that capacity, our market share is going to be lost. All the customers will go to them. Is it difficult to get customers back once you lose them? Yeah, they're happy. They're not going to come back. So all of a sudden, you've got these huge marketing expenses. You've got to have to discount all your products to try to win them back. That is, I think, the worst thing about being underinvested. And the thing is, if there is a spurt in demand, all your competitors are seeing that as well, and if they aren't prepared like you are, there's going to be a demand for capital assets. The production of that is, of course, limited, and you're talking about long periods of time to wait. So key thing is to anticipate demand and have that capacity in place. That's the sign of a successful company, and indeed one that doesn't have too much capacity that's killing its bottom line. So it's a fine line. The timing, of course, is important because you can't turn these projects around on a dime. And if there's a demand that's unanticipated, well, everyone's going to be clamoring for capital equipment, and there'll be long delays in getting there. So these are some of the issues surrounding the very, very important decision. Well, we want to get it right in the sense that we want it to be optimal. So now, rather than sort of engineering management view, let's put on our financial hats and say, well, what does it mean to be optimal? Well, we want the level of investment that maximizes the present value worth of the company. Okay. And think about, the share price of a company, which we sort of talked about, is in a sense, what is the present value? So I'm going to do a P given F. At some interest rate, representing the risk of the company, in terms of some index J, plus the sell price and time period, let's say K, P given F, I comma K. Right? And so essentially, I've got investors who are saying, what's the company worth? Well, it's essentially, and I'm just going to use R minus C here, for revenue minus cost, and R minus C, the net profits from operations while they're holding the share, and then when they dump it, K periods from there. What's this guy here? Well, isn't the investor buying at K periods from now, looking at future profits? So in a sense, the share price looks like this. It's essentially, assuming the company's going to be around for a long time, it's revenue minus cost, P given F, I comma, whatever my index is here, J. And so what we want to do for engineering projects is essentially make sure that our net, the R minus C, is greater than the rate of return required high, which then would increase the share price. Okay. How does that process work? Well, we've got supply and demand. Okay. On the supply side, we have the investors who are willing to part with their money, assuming, they can return on it. Okay. We have the bondholders as well. Okay. On the demand side, we've got all our clever engineers coming up with great projects which require money and, as we'll determine in this chapter, a rate of return. How do we decide what to do? Okay. Well, there's uncertainty out here because the revenue stream that generates this R minus C is uncertain, and the actual cost of the money over the life of the project is uncertain. But it's this interaction in the marketplace that will determine, well, what is the appropriate level of investment. Okay. And I have a schedule on the next overhead where I'll talk a little bit more about it. But what's the process? Well, our shareholders want us to do things that make them wealthy. But we don't want to go out and every time we have a project ask our shareholders, hey, is this a good idea? We don't want to vote, right? What we want to do in the process relies on us doing the right thing through a very impersonal market mechanism. It's this notion that money is available to us on the expectation of an opportunity cost rate of return, and us delivering that determines what we're going to get the money for. And then, of course, on the demand side, our projects, we can measure them. What's the expected rate of return? What are we going to pay for the money? And, of course, we want to make sure that the difference. So management doesn't have to know the shareholders, and they should, through this process, make the right decision. Well, of course, they're incentivized in terms of profit sharing, share options to indeed align their interests with those of the shareholders. In the middle of all this is the board of directors, making sure that the management is doing the right thing. In other words, maximizing share price, share value, while at the same time, listening to the concerns of the shareholders if there's too much risk being put into play. It's an interesting process. It's a very impersonal process. And the mechanism looks something like this. Very, very simple schedule. Think about the demand. The demand comes from our engineers, and this is not an easy process of just looking at all the opportunities out there, coming up with projects, defining them, costing them, and coming up then finally with a plan. So Project A looks like the most interesting one in this company, in that the engineers have come up with a $3 million capital budget request. And using the techniques we're going to talk about in Chapter 4, actually it's 4 and 5, say there's an after-tax return of 25%. Good project. Other set of engineers find another $3 million project that's going to return 20. I think you get the idea. Some folks from Ryerson, they're coming up with a $4 million project that's going to run 8%. G, the government will always take your money and pay you next to nothing in government bonds. So there's an infinite opportunity to invest in government bonds at a very low rate of interest. Your shareholders would not be happy with you if you did that with their money. Okay. So what is the market mechanism? Well, if we go out to the market, we will observe that, as we talked about earlier, we've got a cost of capital. Right? We have a debt-equity ratio that minimizes our cost of capital. Remember that notion of risk between debt and equity. And so we have in our minds what D sub V and E sub V are, based on our experience. And we know K sub D or I sub D from our bond analysis, how we calculate that. We're selling a bond at a premium, this number's low. At a discount, the number's high. And a simple valuation model we talked about for equity, something like this, a number of lectures ago. So the market tells us that. Our engineers tell us that. And so from that, we can infer that, in very common sense, that anything that's above our cost of capital are good projects. So in this particular example, these 4 projects returning greater than 10% are the ones that we should take. So we have a $10 million capital budget next year, and projects A through D would be approved. Well, there's some sort of theory behind all of this, and there's a sort of microeconomics, and we made a full semester course on basic microeconomics, but it's quite simple, really. And our sort of marginal concepts always serve us really well. And the economic theory of the firm, or firm just refers to a company, is really quite simple. There's nothing but terminology here. It's quite simple. If I can spend 99 cents to earn $1, I'm going to spend those 99 cents. Obviously, if it takes me $1.01 to earn that $1, I'm not. Where do I stop? Well, where they're equal. $1 and $1. Dollar revenue, dollar cost. Same thing here. I'm going to take engineering projects to the point where my marginal rate of return of that next investment is greater than my cost. If I do that, well, every R minus C over the year is going to return greater than I, and that, of course, is going to maximize the scale. That's the game. Now, I haven't talked about K here, which is what we observe investors doing to our company the more we go out to the market. And I want to talk a little bit about that, because as soon as you see costs going up from an investor point of view, the first thing you should think about is, there must be some risk. People are demanding a risk premium for some reason or other. So look at the schedule here. For this particular company, and now we're talking about going to the market for a year to do some engineering projects and spending all of that money, benefits occurring 1 year or greater. Okay. Well, the observation is that this company can go maybe and raise $14 million. And no, can make it $15 million. Okay. And let's say they have a debt equity ratio of a third. So it means that if they have good projects, $15 million worth, they go to the market, sell $5 million worth of bonds, $10 million worth of shares, and that cost would be 10%. Okay. And so whatever projects they could do, they better all return greater than 10%. But above this $15 million sort of magic mark, it basically, the investors are saying, yeah, we'll lend you money, but we want more. We want a greater rate of return. And how do they manifest that? Well, remember, when bonds sell at a discount, the rate of return to investors go up. If the share price goes down, rate of return, everything else being equal, rate of return goes up. So from an investor point of view, they're saying, well, we want a risk premium because you're investing more than $15 million. Well, why? Well, think about maybe a $100 million company. Okay? If they go out to the market and ask for $10 million, what are the chances that they're going to mess up that investment? Well, they're growing by 10%. Presumably, management and their infrastructure is clever enough to absorb a 10% increase in value and all of that, what that means. But think about that same company if they grow in 1 year by 20 million, or 30 million, or 50 million. If you're growing by 50%, maybe your management's not clever enough to set everything up to make that work. There's risk. So the greater the percentage capital budget of your company in a year, the greater the risk. Risk, of course, is translated into higher rates of return demanded by your investor. So that's what you're seeing there. Is that bad? Should you always stay on the flat part of the curve and get the cheapest money? Well, think about a company. If I just draw an imaginary line here, they got $20 million worth of projects, really, really hot. Okay? And their return is going to be 22%. Well, if you can sort of imagine drawing from 20 million up to the K, they can go to the market and get 20 million, and investors are going to demand, I don't know, what's a good number? 17%? Okay. So ride this curve up, the green curve, at 20 million, 17%. But then I have a 20 or 25% project that's costing me 17%. Isn't that good? That's just as good as, here, is everyone happy? Well, yeah, investors are happy because they're getting a 7% risk premium, right? They're also, if things play out correctly, getting a 20-25% return, okay? And shareholder value will increase quickly, okay? So it is worthwhile for the company, if it has really profitable investments, to write up that curve. And indeed, when you're really aggressive because you've got lots of potential, you're often writing up that part of the curve. Now, what about, think about risk and management versus the shareholder. Okay. And think about the board of directors being in between. If I'm an investor investing in this company, and let's just say that we're up on this curve at 17%, which means that there's a chance that the company's going to mess up and the project's not going to unfold correctly. Let's say that happens. As an investor, how am I affected? Well, more than likely, I'm holding this company in a portfolio. So this company might represent 5% of my investment. And if it tanks, I'm going to lose that 5%. Does that affect me? Well, I'm not happy, but I still got 95% of good choices. Now, think about management. Management in this company looks at this project and says, hey, this is risky. Do I want to take it? Well, the answer is, if I'm looking at it for shareholders, yes, 25% return on 17% money. But if I'm looking from management's selfish point of view, I might say, well, my entire fortune is tied up in this company. I'm not diversified. Company goes under, I lose my job. Company doesn't do well, all of my share options are not worth very much. And therefore, I have a different view of risk, because I'm not diversified. Okay? And therefore, I may decide not to take risky projects. The board of directors, of course, looking out for shareholders, should direct management to take that money, because that's where the value is created. So one thing about when you incentivize managers or senior executives, you want them to be aligned with shareholder interests. You don't want to pay them $1 million a year, no matter what happens to the company, because they're going to be risk averse. They want that $1 million every year, no matter what happens. You want to pay them $50,000 a year, with most of their compensation coming from performance. Do well, you're going to do well. Don't do well, you're not. Okay? And so this sort of setup here drives executive compensation to a certain extent. So you want their interests to be aligned with shareholders. You don't want them to be risk averse when it comes to good projects. Okay? So key thing here is that we're looking at it from a marginal cost point of view, marginal revenue, where the marginal return really is the marginal revenue, and the cost is simply cost of capital. And throughout chapters 4 and 5, that's our minimum acceptable rate of return, the one that's determined by the K that we talked about earlier on in the course. Okay. Comments or questions? Okay. Okay, so let's talk a little bit about it. Well, first of all, let's review how this part of the course affects our balance sheet. We're talking about long-term assets, and we're talking about long-term funding sources, right? So it's balance sheet, right? Because initially, we're populating the company with equipment, right? That's a balance sheet item. If we're correct, the result of that, the fruits of that labor will flow onto the income statement over the next few years. But initially, we're talking balance sheet. We talked about working capital, just paying the bills. That's not what Chapter 4 is about. It's about the long-term assets and the way they're funded. Okay? I think we've talked about long-term debt, we've talked about equity, and we've talked about retained earnings. In retained earnings, if we're profitable, we don't pay it out in dividends, we have cash to put into engineering projects. We need to talk about a little later about what the cost of that cash actually is. Preferred shares, we haven't talked about, and it's really a hybrid. Hybrid in the sense that a preferred share has an actual dividend rate, let's say 8%. Okay. And it doesn't have the right to force the company into bankruptcy. So if I'm a preferred shareholder, I'm going to expect 8% a year of the profits. And if they don't pay, there's nothing I can do. Okay. So it's a little riskier than debt, because if I don't get my interest payment, I can force the company into bankruptcy and get some return. Key thing about preferred shares, though, is they stand ahead of the common shareholder, so the regular owners. So if I ever miss a payment on preferred shares, I have to catch up before I pay a penny of dividends to my regular shareholders. So it has precedence over the regular shareholders. And so its rate of return is somewhere in between bonds and equity. Okay. And it's a useful vehicle for companies that don't want to go more deeply in debt, but believe that they are going to be very, very successful. And so if they're very successful, they'll get away with paying these people only 8% as opposed to, let's say, a share of 20% profit. It's a hybrid that's useful at times. Well, let's think about now, if I have a capital budget that has a $5 million expenditure. Well, the company will have an optimal debt-equity ratio, and I guess 50-50 is really too high for a company, but let's just use that because the numbers are easy. And so what do I see? Well, I see $2.5 million worth of bonds being issued, and I see $2.5 million worth of shares being issued. Okay. Where does that money go? Well, it goes into long-term assets. And so if this were the balance sheet before the engineers got approval to do this, this would be it after all the equipment is purchased and in place. I see my bond, my long-term debt going up by 2.5. I see my equity going up by 2.5, and I see the fact that I now have $5 million more worth of long-term assets. Okay. So that's the way we represent it on the balance sheet. There is an intermediate step. Think about the day after we sell our bonds and we sell our stocks. Don't we have $10 million worth of cash? Excuse me, $5 million worth of cash. So right after the sale, we would have this, but rather than, well, we haven't spent it yet. The engineers have not gone out and bought the equipment and paid for it. So we have $7 million worth of cash and $5 million worth of long-term assets. Then as the engineers buy the equipment, we pay for it, it goes into production. The cash, the current asset, is turned into a long-term asset. And once the engineers are all finished acquiring all that $5 million worth of stuff, it looks like this. So this is with all the productive capabilities. And of course, there's no cash left because we paid for all that equipment. So that's how it's represented on the balance sheet. And again, it's a long-term side thing, nothing to do with the current. Okay. Now, let's talk a little bit about the nature of the proposals, and then we'll start talking about the process itself. It's useful to categorize our projects into three different viewpoints. And it really boils down to, I guess, where these decisions are made in the organization and the complexity and the risk associated with it. Junior engineers generally are given replacement projects. They're not very difficult. We've got a piece of equipment that's worn out. We know the cost of the old one. We know the revenue that it produces. And so we come up with a decision as to how we're going to replace it. We might look at new technology, but everything's pretty well known. Okay? And so that's oftentimes, something you'll trust a junior engineer to do. Now, if I'm talking about sort of higher up in the food chain within a company, we have folks in charge of product lines or certain areas or regions. And these are the sorts of projects that have greater uncertainty. Yeah, we've done it before, so we know what a certain set of costs are, but we don't necessarily know the revenue, we don't know the new technology we're going to use. There's some uncertainty. Okay? And so these are sorts of projects that sort of are more of middle management concern, a little longer range perspective. And then finally, the last ones are really the ones that determine where the company is going to be. They're strategic. Okay? And these sort of your Steve Jobs type projects, where you're trying to think, well, what do we have to do? Interesting thing is that often you don't have any numbers, right? And so, you're asking for a $5 million project because you think you need to do this, but you have no numbers because you've never done it before. Okay. Those are the ones that are really key to developing the company. And so these are the ones you're going to have to really decide. An interesting thing is, a junior engineer might have to have a 25-page document justifying a $10,000 expenditure, right, on some replacement equipment. But a senior exec go to the board and say, with a one-page executive summary, I need $10 million because I think we need to do this. And the junior engineer may not get his $10,000, but the senior exec may get the $10,000. Okay. So again, what you're talking about here is your reputation as a senior exec, your ability to forecast, and your credibility in terms of driving these sorts of projects and getting money. But these are the ones that are key to your company's future. Of course, the replacement analysis are equally important because you want profitability on your existing plan. So all of these things wrap into the investment proposal decision process. So what's the goal of Chapter 4? Well, we want to make decisions that will maximize the value of the firm. So that R minus C basically being enough to satisfy shareholders, and we want to identify that project by project. Right? So we look at a project and we say, this is a good one because we know it's going to benefit that equation. So the way we're going to look at it is there's mutually exclusive alternatives, i.e. there's competing alternatives to do the same thing. Okay. And of course, we only want one. We've got 5 proposals from 5 different vendors to put in a new computer system. Only need one. So we put all 5 tenders through the process and decide the best one. And then, of course, all across our company, our engineers are coming up with independent projects, right? Ones that have nothing to do with each other, and we want to select all of those that make sense in the sense that they have value. Okay. So the process that we're going to talk about really is going to try to answer these 2 questions. Which of the mutually exclusive projects should we take, and what subset of all independent projects should we adopt? That will then drive the request for capital budget and the corporate financing side. Okay. So what's the process? Well, we can look at it sort of from a orderly process in terms of starting with nothing and coming up to the recommended alternative. I'm going to spend most of the time on step 5, where we're actually going to look at the valuation. Okay. And there's 3 major methods used in industry. First one is payback, where we're not interested really in the time value money. These are inconsequential, very small type projects. Now, I want to buy a tool for $1,000, so we do a quick back of the envelope calculation and see whether it makes any sense. The two methods that are very, very popular when we've got real investments, ones of significant value, are net present value and internal rate of return. Let me start by saying net present value will always give you the right answer. And what's the right answer? Well, those projects that maximize the share price. You might say, well, if there's a method that gives you the right answer all the time, and there's a method that doesn't, why do we even bother with the one that doesn't? Well, internal rate of return, believe it or not, I can have two projects. Let's say they're mutually exclusive. One returns 21%, and the other one returns 18%. Obviously, the 21% project is better. Well, no. It can be that the project with the lower rate of return, measured through this method, is suboptimal, in that the other one doesn't contribute as much value. So the 18% project could be the preferred one because from a present value point of view, it contributes more value. So why do we bother? Well, it's a very, very popular method. Okay, we have to understand, part of my job is to show its limitations. So if you were to just go to Excel and you do an internal rate of return and you come up with the numbers, you might choose the wrong set of projects because you can't rely on the ranking based on internal rate of return. And we'll see why and how we get around it. Okay, so net present value we always rely on. Now, I've never heard in a project presentation someone say, the net present value of this project is $43,321. But they often say, well, the rate of return on this project is 17.4%. 17.8, that's good. That's good. So from a marketing point of view, that internal rate of return presentation point of view is very, very popular, and that's why we're going to talk about it in its limitations. So that's the process. Now, let's look at the various steps, and again, I'm just going to talk very briefly about the steps, but just want to give you a sense of the terminology surrounding this. If I have a number of proposals, I'm going to try to minimize the amount of work. So, less work is always preferred to more work. And if I have some alternatives that are infeasible, let me take them off the table before I do any analysis whatsoever. Okay. So, if I've got 3 proposals, I can arrange them to 2 to the n or 2 to the third alternatives. Then let's ask the question, are there any constraints that would allow some to be dismissed immediately? Just let me define some terminology here. Okay, well, I could have a capital constraint or a budget limitation. I don't have enough money to do all 3. So let's not evaluate it. Normally, in terms of share price maximization, the assumption is that if it's a good project, the rate of return is greater than the cost of capital, I can go to the market and get that money. That's the general assumption. But let's just say that's not the case. For whatever reason, we can't do all 3. So alternative A, I'm not going to do it. Can't afford it. Then I might look at which ones are mutually exclusive. Again, competing alternatives to do the same thing. Only need one. Well, alternatives that have both are not feasible or undesirable, so I can ignore those. And then finally, I've got proposals that are contingent. Okay. So contingency just means I need one before I can take the other. Let's say I've got 2 computer designs here. Okay. And again, these are mutually exclusive. So I've got competition from IBM and Cisco, let's say, for some networking equipment. And I have proposal 3, which is some feature that's only available on the IBM equipment. So if I have a network test system and monitoring system that can only be used on IBM networking equipment, then of course I'm only going to evaluate that networking test equipment with the IBM proposal. So the networking equipment is contingent on the IBM proposal, and therefore it doesn't make any sense doing that or measuring that with the Cisco proposal. So I've got contingencies. And so if I look at these constraints, I can take my initial 8 alternatives and whittle them down to 4, where one of them is do nothing. Okay. And if none of these alternatives have a positive rate of return, I'm going to do nothing. The only consideration with do nothing is occasionally I've got a mandatory project. Okay. Let's say I've got a pollution control project that I need to comply with the law, and the answer is there's no option not to do it. Okay. Well, then do nothing is not an option. And I want to choose the minimum cost option or the minimum loss option to comply with the law. But by and large, do nothing is an option. If the projects are not worth doing, then I'm not going to do them. And so alternative 1 is the way to go. Okay. Okay. So I want to basically do that. Okay. Now, secondly, I've got some alternatives that are feasible that I want to measure, and I want to compare them apples to apples. And I've got the project planning period often tied to the economic life of the asset. And oftentimes I'm using different types of equipment, and they have a different life. Okay. So if I have, let's say, two mutually exclusive alternatives, and I want to choose the best one, and one has equipment with an economic life of 5 years, it's going to look like this, right? Where this is my first cost, this is going to be the salvage value at end of year 5, and this is going to be revenue minus costs. And hopefully by now everyone's comfortable with doing a net present value 5. What's the profit of this project for 4 years, or for 5 years? The competing alternative is the same thing, but it's outselling. It's a different piece of equipment with a different set of costs and revenues. And I can similarly do NPV. But I can't really compare them because they're different time frames. If this were just a cost, what's the cost of running something for 5 years versus the cost of running something for 7 years? Not directly comparable. And therefore, I can't say which one's better by doing this. What I need to do is to have something that's comparable. Well, first thing I can say is, well, why don't I just repeat these to the point where they're coterminous? So if I did this guy 7 times, it's going to end 35 years from now. If I did this thing 5 times, it's going to end 35 years from now. And I can say, well, what's the cost of one for 35? What's the cost of the other one for 35? And I can directly compare. Well, that's nonsense, especially in technology, because it's lucky to get a second cycle to repeat like the first cycle. So to do it 5 times is nonsense. It's called the classical approach to project evaluation. It's in the textbook, but it's not very practical. It gives you the right answer in the sense that if you can repeat these for 35 years, you've got something that's comparable. We don't do it that way. What we do is we say, well, let's have a comparable planning period, which then necessitates one of two things. First thing is, let's say, okay, I want a 5-year planning period. So I want to ask the question, of the 7-year asset, what's it going to cost for 5? So I'm just going to say TP time period equals 5 weeks. But what do I need to do? I need to truncate this guy. And I probably then need to say, well, what's the salvage value going to be in year 5? Well, I'm going to suggest that S prime 7 is going to be greater than S7 because here I've got a piece of equipment that still has 2 useful years of life. Whereas here, after 7 years, the economic life is just scratched. Now, though, if I have a good number for this, I have something that's comparable, a 5-year number and a 5-year number, and I can figure out, well, which one actually makes sense. That's approach 1. Truncate the longer one. Of course, the other approach is to say, well, this really disadvantages this option because it's got 2 useful years of life, and I can't capture everything in this salvage. It doesn't make any sense. So the alternative is to say, well, let's not do that, but let's start this guy up again. And so if I'm going to now say, well, let me have this guy, time period equals 7 years, then what do I need to do? Well, I need to reinvest FC5, and I need to run it for 2 years. I now have 2 projects at a 7-year duration, but I get the same problem. Here now I have S5, but it has 3 useful years of life left. So of course, S prime 5 is going to be greater than S5. Same problem. But now I can say, what do you do in practice? Well, a form of this. In larger companies, generally there's an engineering economics group, and they will give us engineers guidance as to how a company does this for uniformity. One example I know is Bell Canada. I'm just going to wrap up with this example. So Bell Canada, when it looks at these sorts of projects, has what we call a standard planning period. So, final thing there. If I have computer equipment, no matter what the economic life happens to be, we wrap the project up after 3 years, or they do. If I have a telecommunications project or a networking project, we believe that equipment has a more or less 10-year life. So we use a 10-year planning period. Fiber optics, We think fiber optics is glass that lasts forever. It lasts for a very long period of time. And if it's a fiber optic project, the engineers will do the valuation over 25 years. So you still have this problem, but at least uniformly done across the company, and the engineers will give them some guidance on how to do it. Okay. So essentially, we've got alternatives, we've got cash flows, we've got a planning period. Next day we'll look at actually how we're going to evaluate the project. Okay, thanks. Have a great weekend.
搞定了。